So I will always mention this when I start the recording. So if I've missed mentioning it, that means I've forgotten to record it. So please remind me. Many of you are quite prompt about that. So please keep an eye on that. Okay. So this is what we did the last time. Underlying positions on the FX and rate risk, on the long-term loans, the FX and rate risks on the long-term loans. That's what we discussed the previous day. So there is a floating rate loan in US dollars, and I'll just bring in my editable version of the sheet here, right? And so we discussed the FX and rate risk loans, FX and rate risk on these loans, how you manage them. We discussed the entire system of how you lay out the exposures year by year, how much is payable. Okay, and we also obviously discussed what is the underlying position in each of these KRF markets, which is our second question in the case. The second question in the case is the underlying positions with respect to each KRF markets, and we went through that. And that's what we found here is that the underlying position here we found is long dollar yen, because remember the underlying position is always to be considered with respect to a particular KRF market. Let me see here. If I'm making the notes here, I'll later on we'll try to consolidate it into answers for the particular case questions in the case. But at least you can have it here, and then you'll have a record of the answers here. So you will know what we have the main points written down. You don't have to take notes. So we got this. This is what we discussed: underlying positions on FX and rate risks, and this is what we discussed. So the point is that the underlying position that we are asking about here. See, the question is underlying position with respect to each KRF market. This is how you have to think about the concept of the underlying position. Okay, and with respect to any position, actually, you always have to think about a position as with respect to the position as either long or short. And if you're long or short, that means you're long or short some base asset or terms asset. And what does that remind you of? That reminds you of a market where you exchange two assets against each other. And in this case, since we are discussing the hedging context, we have to identify the key KRFs, even in a speculative context, but mainly when you're doing risk management, you have to identify the KRFs, that is the key risk factors, the prices which will affect the value, which will affect your net worth. So therefore, underlying positions are always with respect to a KRF market. So when we talked, for instance, yesterday, just to recap once, that let me just put this here. Well, actually, for today. And this today is 27. And so we are just writing a little bit here on this. Okay. That's a point, actually, right? So when we talk about underlying positions, we are always referring to that position with respect to some KRF market. Okay, in this case, in general, to some market, but since we are discussing risk management, this concept, the additional concept of the KRF comes in, because as a risk manager, your first target is to come into the trading room and or to the treasury and quickly size up what are the particular market prices that are going to affect your net worth. Okay, so like the price of land, real estate in Tokyo is not going to affect anything on this balance sheet. So you don't worry about that. Now, even though these guys actually might be based in Tokyo, the price of real estate is not really going to affect their balance sheet. So at least not in the short term. So you worry about the stuff that is going to affect the net worth, and those are our KRFs. And then we start looking at the underlying position. So now what we said here was in the dollar yen, So here the KRF market is actually dollar yen, because you're supposed to look at all FX risks on using spot markets. Even though you might hedge you're supposed to analyze all FX risks using spot markets. And even though you might actually hedge using options or futures, etc. So you look at it from the spot market. The spot market, the convention is the dollar is the base asset. So this is a dollar yen market. Okay, as you can see here, spot dollar yen. And here the underlying position, as we discovered, was long. You're long dollars and short yen, okay, and therefore you're long this dollar yen market, because here the base asset is dollar yen. The base asset is US dollars. In this market, as AA pointed out, this is here the market. The position is short, okay, and the market here is Aussie. We just call it spot Aussie, but it's actually Aussie against US dollars. And you can see Aussie is the base currency. And so you're actually short because you're short the base currency. So we say the market export, the underlying position of this KRF market is short. And in this case, we defined the 3-month LIBOR as the KRF. And so we said here the market position is short. Now, here's an alternative way to, let's look at it here today. What are we going to discuss? This is just a recap of what we did the other day, okay? Let me just give you another idea, because what we did was kind of mechanical, in the sense that we changed these prices in order to figure out. So this logic is also very important to understand. And once you understand it, you don't have to memorize it. You will know that it's very logical. Okay, as you can see, Utsav was able to grasp it quite quickly in the first session itself. Then he had understood the point, the logic, that you have to figure out basically how do you figure out if something is, your position in a market is long or short. You see what happens if the price, do a scenario analysis, let the market price rise and see what happens to your net worth. Does it go down or up? And if it goes down, that means you're losing money. So market price rises, you're losing money. That means you must be short. And the same logic. I'm not repeating the whole logic, but please practice it on your own, so that once you understand it, you don't have to memorize it anymore. That's one way of doing it. The other way of figuring out, especially whenever you're looking at a balance sheet kind of scenario, and most scenarios can actually be framed as a balance sheet setup. Okay? So for instance, as you can imagine, if you imagine now that this is not the stuff, we are looking at, say, Aman's option trading book. And so what you have basically here on Aman's option trading book, you would have this part would be some amount of cash on the liability side. Okay, let's assume that he's just using his sorry, not cash won't be on the liability side. If he's just using his own money, so the whole thing on the left, on the liability side, would be net worth. Okay, and on the asset side there would be some cash, and the rest would be all the hundreds and thousands of options that he had bought in the last project. Okay, so that would be the split on the asset side. So some would be cash, which is non-risk, no risk, market risk on the cash. But on all the options, okay, on thousands of options he had bought, he will have dual exposure on each option. IBM calls, exposed to the underlying price movement of IBM, also exposed to the eyeballs on IBM options. Each option you'll have a dual exposure on the eyeball and the underlying asset. Okay, and you could make money on one factor and lose money on the other factor. So this is how you would look at it. So even something that you normally don't think of Aman's trading book as a balance sheet, but even that can be thought of as a balance sheet, because if he's trading only with his own money, he has not borrowed any money. And if he borrows any money, then you split up the liability side into some amount of net worth, which is his own money, and then the rest he takes all kinds of loans and loads up his balance sheet, and then he has more money, more cash on hand, and then he can bet bigger on the financial markets. So the same thing. So any kind of exposure, pretty much every kind of exposure can be mapped onto a balance sheet kind of setting. So what we are going to learn is another way of understanding underlying positions. Okay. True. And here I'm going to start writing in caps so it's easier for me to see. Balance sheet constructs. Okay, so balance sheet constructs is essentially assets and liabilities. Can I save myself some work? Okay. All right. So what we do? So if something is, if something is an asset, okay, and we have items which are assets, items which are liabilities. So just by looking at something, so now what we're actually trying to do is, the other day, I'm just trying to give you another way of looking at understanding positions, which will enrich your understanding of the whole, area, which is that initially we figured out how to understand whether our position is long or short, is we see what happens when the price goes up, what happens to our P&L, and accordingly we decide whether we are long or short. That's one way. And the other way to do it is to look at whether something that you have is an asset or a liability. Okay, so if it's an asset, what does it imply for? We'll copy this. We'll not waste our time writing this. What is the underlying position likely to be for that which is an asset? Long or short?
Long.
Yes, long, right? And where the underlying position, where the items which are liabilities, this is very complicated and very difficult. What will be the underlying position? This should be short. Okay, so this is another way to figure it out. I want to make sure you also understand it intuitively, because the first rule we gave you, that can become a little mechanical. Okay, you don't really think about it. So now try to apply. So this is the other way to think about it, that if you have an asset, then that the underlying position there is long. If you have liabilities, the underlying position is short. Okay, and here you can see what that means, because a liability is something that you have to pay. Income taxes payable, accounts payable, okay, short-term loan, long-term loans payable. All these are things which you have to pay. So therefore, these are liabilities, and these are therefore, if you have to pay, that means you have a short position. Why? Remember, what is a short position? Is where you have gone short in a particular market. Short position. So we have agreed. Remember, a transaction in a financial market is if you go back to your notes master, and if you have this note, if you go back to this note and see, transactions as contracts to exchange assets, base asset and terms asset. Okay, so if you what is a transaction in a financial market? These things have happened because you did a transaction. All these loans, assets, liabilities have happened because you did a transaction. Okay, and so you can think of this as, although it came out of the ground, all this stuff, but you can assume that you can also think of it as if you kind of bought this stuff. Okay, so therefore what you have, a transaction is a contract to exchange assets. So, and when here what you have in a settlement date is you have the transaction date and the settlement date. When you have a contract to exchange assets, that means finally you have to discharge your obligations under the contract. A contract gives rise to, we have to connect it to the law as well. When you enter into when you do a transaction in a financial market, you're entering into a contract to exchange assets. A contract gives rise to obligations, rights and obligations. You have a right to receive the asset which you have bought, and you have an obligation to deliver the asset which you have sold or agreed to sell. Okay, so now this is what happens on the transaction day. You enter into the contract and you crystallize your liabilities or obligations under the contract, and then you have to discharge your obligations, and that discharge happens when you finally do your part in the contract. And on the settlement date, what is your part in the contract? You have agreed to exchange assets, so you have to actually deliver those assets which you agreed to sell, and the one which you receive, the one that you agreed to buy, and that exchange happens on the settlement date. Okay, so this is basically therefore when you're short, okay, it's a liability. When you're short, you have to deliver. Why is it a liability when you're short? Because when you went short means you agreed to, when you go back to this framework, it's a contract to exchange assets. When you agree, when you went short, you agreed to deliver that asset. So now you have to deliver it, so you have a liability there. Okay. So when you go back like that and think about it this way, you can see here what you took this yen loan, right? So you have all these liabilities that we laid out like this. Okay, all the payables, you took a fixed rate loan. All the interest payments, we took a simple case of 1 year annual payments on the interest on the loan. Usually it is around 3 months, every 3 months or semi-annual. But here we took a simple case of annual. All the payments that you have to, these are all your liabilities. Okay, and then you have to pay the principal P plus I at the end as well. So these are therefore shown on your loans. These are long-term loans payable. These will be shown under long-term loans payable, Japanese yen, and then you will split it up into all the different currencies, yen, Aussie, Canada, whatever loans you have. So the other way to think about it intuitively is to be able to understand whether your position is short or long. You have a short position, which means you agreed to sell something. You agreed to sell something, so therefore you have to deliver it. And if you have to deliver it, that means you have a liability to deliver that. So that's showing on your liability. So therefore the position with respect to yen must be short. The position with respect to Aussie must be short. And then you have to work it out further. Okay. Then you have to convert it further. Okay. That what should we use here? As okay, let's use inferred. Or convert or restate, not convert actually. Restate will be better. Restate as. Convert would have been into, but restate is as long short position and we can put it specific KRF markets. What do I mean by this? That this particular last part here, so what we are saying is first figure out by looking at the balance sheet, wherever you have assets, and remember this logic, why are liabilities the ones where you are short? Because going short means it's a contract to exchange assets. That means you agreed to sell it. That means you have to deliver it. If you have to deliver it, you have a liability. So that means whatever you have a liability in, that you're short. You're short that asset. And then accordingly, similarly, you are flipping the logic around. You are long the assets. Wherever you have assets, you are long. You have an underlying long position in those assets. Okay. Now, so from using this logic, at this stage, you get to this. Yeah. All right. You get to this using that logic. When you analyze the yen loan, you look at this. So you have to pay yen. So yen is a liability. So that means you're short yen. Okay. You're short yen, that much you know at this stage. And then what I'm saying is that I'm saying finally restate the long short position as you have which you have derived from this, because what have you up until here, this step, what have you got by using this logic? You have understood that you're short yen. Okay, you've understood that you're short yen because yen is a liability, but you still don't know what your underlying position is with respect to the dollar yen KRF market. I mean, as if you're a computer, you still don't know. So I'm teaching you to think like a computer. You know that you're short yen, so that's why you have to now restate the long short positions as inferred above as long short positions existing in specific KRF markets. So the point here is, the reason this kind of extra step is important is because the KRF market is a dollar yen market. So whenever you discuss the position in a dollar in a particular market, you have to discuss the position always with respect to the base asset. Let me just remind that once again. You know this term, I think many things, some batch I remember guys did not know what NB is. You know what NB is? Anybody knows what NB stands for? NB stands for nota bene. That means take note, basically. So the NB means important. Watch out for this and whatever. Please take note. Okay, it's a notation that we use. It's a kind of a shorthand. It's like IE. So NB. Okay, this NB is this nota bene. Don't write it like this. Just write NB. So here I'm writing a note here for you guys. For in this logic, what is it? Remember NB? That positions the underlying positions when discussed with respect to any KRF market are always with respect to the base asset. Remember that. Okay, that's the other last part of the logic. So I'm making sure that we go stepwise. We have now figured out the logic why as to why liabilities, if you have anything showing on the liability side, any asset, any particular mark here, these are actually all assets, but because you have to pay the asset, I mean, in a general sense, these are all, yen is also an asset. Okay, but in your case, it's a liability because you have to pay it. So in this case, and that I mean, what I mean by yen as an asset is that Japanese yen currency is also going to be considered an asset. Okay, so and a currency is a species of asset. So what you have figured out is because it's the Japanese yen loan is showing on the liability side, that means you're short yen. Straight away, you know that. Okay, from the logic that we have just discussed. But you have to state it's not sufficient for you to say that I'm short yen. The point, and this is the point I'm trying to make here. Underlying position when discussed with respect to any KRF market are always stated as long short with respect to the base asset. Okay, this is the point here. So the point is that you have to state your underlying position with respect to the KRF market, which in this case is dollar yen, and which is the particular market that you will be watching to monitor your risks for reduction in net worth. And all you have figured out up until now is that the yen is, you're short yen because it's showing on the liability side. So now you have to take the extra step and understand that in this dollar yen market, the dollar is the base asset. So if you're short yen, you must be long dollars. So therefore, as far as the statement that you're going to make with respect to your underlying position in this KRF market, never mind the fact that you're short yen, you have understood that. You have to restate that as being long dollar yen, which means long dollars and short yen. Because when we say long copper, long dollar yen, long euro sterling, what do we mean? Long euro sterling means we're not long sterling because euro is a base asset in euro sterling. So if I say long euro sterling, immediately people understand that I'm long euros. This is how you talk, right, in the markets. So you have to say that in this KRF market, my position is long. My underlying position is long. Because I'm long dollars. Why am I long dollars? Because I'm short yen. So the logic comes from this. See it on the liability side. That means you're short this item. Now, then what is the KRF market? It is dollar yen. In that dollar yen market, you are short yen. But yen is actually the terms asset. So you have to state your position with respect to the base asset. So you say that in this KRF market, my position is long because I'm short yen, therefore I'm long dollars, and dollars is the base asset. Okay, is this clear? Very simple stuff, but I'm making sure that you have to understand the logical steps at each, all the small logical steps, because it will help to solidify your thinking. Once you understand things conceptually like this, and once you are once you have trained yourself to speak in a highly specific manner, whatever you say, even one word here and there, you have to be highly specific. even though people in industry may not be that specific. But if you train yourself to be that specific, your thinking will remain clear. Okay, so that's all we are saying. We are writing a lot of stuff. Actually, it's very simple, but it's important to train your mind to be thinking like a computer. Because remember, if you're giving instructions to a computer, you'll have to go like this, because computers don't jump ahead like us. We can jump ahead. Like if you saw in the previous class, when we were already discussing dollar yen, double A had already jumped ahead to Aussie dollar, and he had already figured out that position in Aussie dollar is short and the underlying position in. So computers don't jump ahead. Computers have to be told everything and step by step. But it's important to train yourself like that. Okay. All right, so that's one way. So now you know how to intuitively figure it out using balance sheet constructs. So that's the thing that we learned here, this point, that how to figure out underlying positions using balance sheet construct like assets and liabilities, and how to figure out what is your underlying position. But remember always that you are going to have to state it with respect to KRF markets, and you will always have to state it with respect to long short with respect to the base asset. This you have to remember. This is the convention in the markets. Okay, so that's one. Okay, so now we'll go on to our next part of the coverage from the notes. And we are starting to now get into what you'll have to do in your project. Right. So what you will be doing in your project is essentially managing these risks. You can't touch the balance sheet. You can't touch the underlying business, how it operates. You can't disturb the sales team or the production team or the operations team. But you have to watch the exposures that are all the finance team. You can't force them to, I don't like this yen exposure, quickly pay down this yen loan. You can't do that. If you don't like the yen exposure, you don't like the way the dollar yen is behaving, then you create an offsetting position on your hedge book. As the manager of the hedging team, you are allowed to run a hedge, a bunch of hedge positions. You're running a hedge book. You have a bunch of hedge positions, long, short, whatever you want, and you're watching the markets, you're watching the KRFs, and you know what the underlying positions are, and therefore you know what the risk is. And then if you see a risk of a reduction in net worth, you will put on an offsetting hedge in your hedge book, on your hedge book. And thereby, and if your view turns out to be correct, the underlying positions will lose money, but the hedge positions will make money. So on a net basis, you would have locked in the net worth at that level, okay, when you decided to put on that hedge. That's basically the scheme of your whole project. But obviously, it's made much more complicated because you have to manage, you will not be managing the 3-month euro dollar in this particular project. So you will have to deal with 5 KRF markets, and then you will have other kinds of problems, because in the sense that these are all problems that are meant to train you to do a better job, to get ready for how it works in the real world. That when you're managing, especially the yen loan, you will have to do your analysis using the spot market, dollar yen, okay? And then you will have to look at 3 months, okay? Then you have to look at the dollar yen spot charts and take up and form your view. Is this going up or is this going down? And when you start to hedge, when you see something that requires you to hedge, you will not be hedging using spot markets, you'll be hedging using futures markets. So you have to go into the CME futures where the quote is on an inverse basis. So in the CME futures markets, the yen is actually the terms asset. So this quote is inverted when you look at it, all right? The CME, the yen is the terms asset. So you have to be very careful. And these are all things you will learn. That is the whole point of doing these kind of projects. From looking at this market, you have to figure out what you want to do in the dollar yen spot market, whether you want to go long or you want to go short. In this case, it's very clear to you because you're already long this dollar yen market. You can't go long anymore as a first transaction. You have to reduce risk, so you have to go short. So you have to go short. Now, there's a question of timing. When you have to go short, okay, you have to, when you decide to go short, let's say you want to go short at market, what you have to remember is in the futures markets, if you're going short means you're selling here. If you're as a hedge, what do you want to do? Think about it. You want to sell dollars. Okay, you want to go short means you want to sell dollars. And sell dollars means you want to buy yen. You want to sell dollars, you want to buy yen. Now at this stage, you jump over to the yen futures and you want to buy yen. And in the yen futures markets, yen is the base currency. So what will you do to the yen futures? You will buy the yen futures. Okay, if you were trading in spot, you would have sold the dollar yen. But actually you're trading in futures, so you will actually buy the yen futures. Okay, you'll buy the futures contract. So you'll hit the offer side of the price, not the bid side. So these kinds of little things which you need to just we are going to now look at the third question which we have, which is the generic decision problems. Okay, there are two topics which we are just skipping over. Okay, which we will discuss later on. I want to just get you ready quickly for. So what we are skipping over is actually basis risk, hedge transaction, hedge position. Basis risk and types of hedging programs. We are skipping. We'll make a note of it here. Okay, we're skipping this. Now we are going on to this part, the decision problems and hedging passive risk books. You'll see this, right? So this, remember, this is what we are describing as a passive risk book. Let's bring this to close to our balance sheet. So we have this, okay. And we may need this also. Right. So we are now looking at this decision problem. Going back to the decision problems that we first discussed when we were discussing active risk books. Okay, active risk books were your speculative trading books, like a HDFC mutual fund or a quantum fund, which is a hedge fund. Then any kind of your own trading books that you're running. Vipul is running his trading books in Indian equities and options. Those are all active risk books because they start with a kind of a setup where you have all, let's say there's no debt, there's no borrowing. So this whole side, liability side, is all owner's equity or net worth. Okay, and they start, the first starting position is all assets. All assets are in cash. They open the account with a broker. The whole thing is cash, and then this is an active risk book because they could have retained it as cash. They could have just put something in a in a public sector bank in a local currency deposit, which is effectively risk-free. Or you could have just invested everything in treasury bonds, which is risk-free. So there would be no risk on this book. But they decide that's not going to make them that much money, so they'll keep a little bit of cash and they invest the rest of the cash in buying risky assets like gold, copper, crude oil, some stocks, Amazon, Facebook, etc. Buy some stocks, and therefore hope that those stocks go up in value and then you make some money. So that's an active risk book. Here you're looking at a passive risk book because the company is running a business. They don't want to speculate on these prices because if you wanted to do that, it's much easier to do that through futures contracts. Just open an account with Interactive Brokers and start trading futures contracts. There's no need to be running all these mines in Indonesia, running a copper mine in Chile, all this headache of dealing with the labor unions, all these problems and the supply chain problems, disruptions here and there. No need to go through all these headaches. Just open an account with Interactive Brokers and start trading futures. Very clean way to speculate. So these guys are not in the business of speculating. They want to extract the efficiencies from the value chain. But because their inventories, okay, in some cases, their inventories, whether it's showing up on the asset side, these happen to be commodities which are very actively traded, and so prices are rapidly changing. And even on the liability side, they may have all kinds of exposures, as you have seen. So this is basically happening out of what is happening in a passive risk book is, what is happening is these guys are running a business and they're taking some reasonable decisions in the course of running a business. They got some very low interest rates on yen and Aussie, so they took some loans. They got favorable terms, so they took out some loans, even though they don't have any assets in yen and Aussie. All their assets are in US dollars. Their revenues are all in US dollars. Their revenues are on the asset side effectively, okay? When you try to set them up in a balance sheet framework. Revenues are on the asset side. Okay, so now, basically because you're long whatever your revenues, the currencies in which you get your revenue, the currency in which you get your revenues. Now, because of this, because of the way they're running their business, they have certain risks. They have decided to run their business in certain ways, and now they have ended up with certain risks. So it is called a passive risk book because they did not actively put on the risk like Vipul or Aman or HDFC Mutual Fund. They were just running their business, and passively they ended up with some risks. So you have to manage the risks on that. Now this is what corporate treasury risk management or hedging is all about. Okay. So now we go back to the concept of the decision problems which we encountered earlier when we were looking at your active risk books. Okay, if you look at it now, what we are going to do is we are trying to see whether is there any. We just discuss how those problems are solved. Okay, and we'll see how. Look at the question in the case. Okay, he's saying that the CEO knows the problems involved in managing an investment fund. Okay, so he's already gone through your first two projects. He knows what kind of decision problems you have. And he's wondering how those decision problems might apply here in the hedge portfolio management context. Is there anything which is automatically solved and any problems which have to be actively solved? So what is the nature of the solutions to these problems? Okay, and for dynamic and static hedging programs. So actually, I should have discussed this part. Discuss scenario. Okay, we'll put this as a separate question. We'll discuss this question a little later. First, let's discuss this one. Okay, let's make this. It's okay. We'll make this. We'll just put it as a separate question. We'll come to that later. So let's look at this. The research. So if you remember the DPs that we had earlier. 1, 2, 3 asset class market instruments. What is the situation with respect to asset class, market, and instrument? Do we need to select? In the case of active risk books, if you remember, in general, these are decided how? Yes, you remember this word? Direct or indirect investor mandate. You've forgotten everything. Everybody has forgotten everything. Yes, remember, let's ask Priya, what is meant by direct investor mandate? No? Priya doesn't remember? Okay. Are you guys able to hear me? Nobody.
Yes, sir.
You can hear me. Okay. So everybody's forgotten what direct and investor mandate is. So you have to remember these terms because your financial.
directly by investor mandate is basically explicitly himself specifies the asset class market instrument to be traded.
Correct, correct. Indirect is where you think that you have a specific you have a specific expertise in private equity and real estate investments. So if you open a real estate investment fund, and then you effectively you think that there is a demand. So there are two things: you think that you have an expertise in that, and then you think there's a demand for that. So in a way, we are calling it an indirect mandate. You can also call it an investor expertise-based decision selection, where the investor feels there's expertise, and also there is a market demand for real estate investment funds. And so therefore you go and launch obviously you only launch things which there is a market demand for something. So you launch a real estate investment fund because you think there's a market demand for it. Okay. So what happens in this? So in this case, what happens? In this case, do we have to decide anything in terms of asset class, market, and instrument?
No, sir.
No, right? No, we don't have to decide. Okay. Yes, you're right in the sense that let's look at what is already decided. Let's try and put some of these let's see what we have now. Okay. Okay, so the static hedging problem is basically we are talking about static hedging programs. Okay, at this point we'll discuss it as static hedging programs. So static hedging program means essentially if you remember what Hull had referred to as, Hull Basu referred to as hedge and forget strategies. If you refer to the parts of the text that I have referred you to, hedge and forget strategy, which means once you hedge it, you don't touch it. You don't hedge and unhedge and hedge again and all that. So that's what a static hedging program is. Okay, so we're not discussing the dynamic hedging programs, which we'll come to, because actually in your project you'll be doing dynamic hedging. You have been given the flexibility to do the dynamic hedging program. We'll explain that later, but let's just assume it's a hedge and forget strategy to keep it simple. Okay. So what we are talking about is, look at this. Is the font size very small here? Can you still see it? These things. Can we still read the stuff?
Yes, sir.
You can read it. It just goes a little bit. Okay, so if you can read it, then I won't change it because it was nicely in one line. Okay, yeah. Okay, we'll keep it at least as this at 11. Right. So let's go through that so that it is correct that we are basically not, we don't have to decide much. We don't have to make an asset class selection because when we look at we can look at the KRFs, we can see that some of these are commodity markets. So from the markets itself, the asset class is decided. Okay, because we have the markets, we have the asset class. These are all, that's why I've written this as auto. So let's go through the note here, what we have done in the note so you can follow the note later on. We are recapping here the decisions in managing an investment fund. But this is nothing new for you. You already know this. And here we are talking about, this is all old stuff. Now we are talking about managing financial risk within a corporate treasury setting. Now we are going to discuss the same decision problems and we see how we're going to solve them. And we may find that some of those decision problems are automatically solved. So maybe this is the part where there was a problem. We'll see. We'll check this link. Okay. We'll refer to this as, okay, question 3 in the case. This is the question 3 in the case, right? Question 3 is the decision problems in this case, right? So in any case, if the link doesn't work, just go through your notes folder and it should work. So now we're looking at the same decision problems and we find that because when we looked at the KRF markets, we have identified the KRF markets and we know the markets. We know the markets where the company has exposures. And we therefore also know, since we know the market, we can classify it into an asset class. So we know the market and we know the instrument. We know the market, and because of that, we also know the asset class. So obviously, if we see that Aussie to Aussie US FX spot FX, Aussie against US dollars is one of the markets, then that the asset class for that will be currencies. So by looking at the market, we can figure this out. And we don't have to actually think actively about what market should we invest in, because the underlying positions already exist. And we are only concerned with the underlying positions that exist. So here there is no, for instance, there is no euro sterling position. So we're not going to worry about a euro sterling exposure. So we don't have to think about many things here because the markets are already given to us. We are only concerned with the KRF markets that in which we have underlying positions. As a hedging team, we are only concerned with those markets. So for us, the decision with respect to asset class and markets is very easy. It is actually automatically solved. Once we have understood the underlying positions that exist on the balance sheet, the underlying position with respect to the KRF markets, we have already identified the markets. And if you look at the market, you can see that in this case, so this will go into commodities. In this case, this will go into currencies. So these are automatic, the first two. Instrument, however, is a different ball game, because you can decide here, okay, you can decide how you want to run your hedging program. There may be, in many companies, there may be some types of restrictions on what kind of instruments you can use. They may have some restrictions on the use of options, etc. So, or you may have a problem of not being able to sell options. So as far as when we discuss asset class, market, and instrument together as three decision problems. But and in this case, when we discuss that, we find that the third one, instruments, is not automatically solved. This is an active decision to be taken by the hedging team and also the corporate board. The corporate board will discuss looking at a corporate treasury risk management setting. So the risk management policy, etc., will be set by the corporate board. If you remember, you might have studied you have done some courses on corporate governance. As part of corporate governance, this is one of the things that will come into corporate governance, the whole aspect of risk management. So you have to make sure that the company does not go bankrupt because of massive movements in asset prices. You might have such a massive drop. You have huge inventories in these commodities which are not hedged. And then there's a massive drop in commodity prices, so massive that your net worth is wiped out. So you have to manage that. So that falls actually within the larger umbrella of corporate governance. Risk management falls under the larger umbrella of corporate governance. So the board is also going to get involved. In a large company, you will have a risk management policy. Okay, the board will come out with a risk management committee. There will be a risk committee, and there will be a risk management policy which will set out the parameters, if it is well managed, which will set out all these parameters as to what you can do and cannot do. So it will make statements about the instruments. It will tell you whether you're allowed to hedge using spot, or do you have to use forwards, whether you can use spot and FX swaps, whether you have to use only forwards, futures, options, whatever. Everything will be stated. So the point is that this decision is active. This is not automatically solved. You have to actively solve it. You mean active in the sense that which is the hedging team has to solve it. Okay. They are referred to the corporate risk management policy document. So you understand the whole setting, how the whole system works. Okay. This is actually surprisingly, many big companies also are not very systematic about this, and people have lost a lot of money. In fact, JP Morgan Chase, I don't know how many years back it was, maybe about 4 years ago or something like that, 4 or 5 years ago. They lost about $6.3 billion, that's B, as in Bombay. $6.3 billion they lost on some really stupid credit derivative transactions that they were doing out of their London treasury. This was known as the London whale disaster. You can read up on it if you want. Okay, I'll just write about it. This is a risk management disaster. You can just query it and see. You can check about what was JP Morgan. and it is credit derivatives. It's in credit default swaps. Okay, credit derivatives. Disaster. You can read about it. There's also a Harvard case study on this, but I can't find it anymore. So, but anyway, this is a story for you to learn. It's a London whale disaster because it was called a London whale. I mean, the trader was in London, obviously, and he was a whale because he was so big. His positions were massive with respect to the relative to the size of the credit derivatives market. The overall credit derivatives market is not that big, not like spot FX or something. And this guy had massive positions. So his trades were moving the market. And he was doing all kinds of funny stuff. As you will see, I will discuss certain golden rules of hedging, and he was violating those actually. So he was essentially what he was doing is when you already have a long position in commodities, you are not allowed to go more long than this, okay? You can either decide, okay, your long in gold is 2,500. You can either decide that the gold price is going to keep on going higher, so I don't need to hedge. Or you can start reducing the net position by putting on short positions as short hedges, okay, and reducing the net position. You are not allowed under any circumstances as a hedger. You're not allowed under any circumstances to increase the net position beyond this. I will come up with this. We have something there in your notes called the golden rule of hedging. This is basically one aspect of one side of the golden rule of hedging. If you are going to be hedging, remember hedging always has to reduce risk. So you're starting with 2.5K of gold. Okay? So under no circumstances are you allowed, if you want to be called a hedger, under no circumstances are you allowed to increase the total risk, which means underlying position plus hedge position. You cannot increase that total risk beyond 2.5, beyond the starting point, okay, or whatever this becomes. Later on, you get an update from the production team that, okay, we have refined maybe 6,000 more ounces of troy ounces of gold, and those are also sitting in finished goods inventory. Then you update your finished goods inventory figure. It goes 2,500 plus another 7,000 troy ounces, maybe whatever they said. So that figure becomes 9,500. In which case you're talking about 9,500. But whatever is the finished goods inventory, whatever is the underlying position, okay, the updating initial and updating underlying position, you are not allowed to go beyond that under any circumstances. If you do that, you're not hedging. Then you're speculating. So these idiots, in the London trading, and this is a very badly managed incident. They lost 6.3 billion because this guy started doing this. This is basically what he was doing. Instead of hedging, he went and increased his position. He should have actually been either saying keep the same position because of his market view, or reduce the net position. But he started increasing the net position. So he was not hedging actually. In the name of hedging, he started speculating. This happens a lot. It is quite surprising how often this thing happens. This should not be happening at a big institution like JP Morgan, a giant of a bank. Okay, but it happened just about 4 years ago or something like that, maybe 4 or 5 or whatever it is. You can look it up, what the date is. It's a total disaster, absolute managerial disaster. But these things happen in very big companies. And there are many, many stories. If you remember that I've given you a certain chapter in the Hull Basu book to read, which talks about derivatives risk management disasters. I think it's towards the end of 36 or something like that. Just check your notes. That is basically full of these kind of stories. So it's very important to know about these stories, because one thing is that when you're being interviewed, if some opportunity comes up, they're discussing some scenario, and you can say, no, you know what, this is just like that London whale disaster, or this is just like the Sumitomo copper trading disaster. There was a guy called Mr. 5, similar situation, Mr. 5%. There was a guy called Yasuo Hamanaka, who was a Sumitomo London copper trader. He had massive positions in the copper market. Sumitomo is a Japanese trading company, obviously, one of them. So these guys they are big traders in physical copper. And this guy had bought so much copper that he was like moving the copper market himself, because his positions were massive with respect to the size of the copper market. So he was called like Mr. 5%, and then he ended up losing a lot of money for Sumitomo. So this is a very common problem that happens because of poor risk management policies. So you would be surprised how bad risk management is at even big corporations. It's shocking, actually. And so it's a massive case of corporate governance failures. But these things keep happening, so you have to be aware of all this stuff. Okay. So asset class market instruments is an instrument is active. It just has to be coming out of the corporate risk management policy document telling you what you can invest in, not invest in. Okay. Now, what about buy sell? Remember the original DP4 buy sell? I am here in a trading in an active risk book management. I have decided to trade dollar yen. I come into the market and I look at this dollar yen chart and I'm confused now. Should I buy or should I sell? Because I have an active risk book, I have zero risk to start with. I've got owner's equity on the liability side, and I've got all cash on my asset side. I want to put up some cash for margin and create a dollar yen exposure. But I don't know whether I should be long dollars or short dollars. I'm getting confused. So I'm asking Sachin for a view. What should we do? This is the kind of problem that happens in active risk books. What about passive risk books? When you think about DP4, okay, let's take one example. Let's take the example of crude oil. Okay, so when the hedging team is looking at crude oil, so let's change the chart and let's make it US oil. So here we have US oil. Let's look at some longer term exposure. Oil price is still going up. Yeah. Okay. So now notice here. Okay. One more thing I would just say. Remember, always understand the connection between politics and economics. These are very big markets. They have huge impact. You'll notice now that Joe Biden's policies are actually not very friendly towards these fossil fuel markets. So you have to watch how the market is reacting. He's already passed some orders. Generally, he's going to ban leases on federal lands for oil drilling. So that will be negative. It will basically tend to restrict U.S. supply of U.S. Production of oil because he's banning production in various. So this is a big contrast to Trump, because Trump was very pro energy independence, and he was quite liberal with respect to oil drilling leases and things like that. So there is a big. So you have to understand when you're looking at politics, you have to also understand, and these things have a big impact. Okay, if you are going to substantially restrict U.S. energy production, that has all kinds of ramifications, not just in economics but also in politics, and basically also in terms of military impact and all that, because then the U.S. will become more dependent on Middle Eastern oil, all kinds of implications. So you should be conscious about all these things, how changes in politics lead to changes in policy, and that they have geopolitical implications. So this is good for this reduction of U.S. production of crude oil is good for countries like Russia, Saudi, Iran. Those are the other major oil players. So they are in a more dominant position if the US production is going down. So these things you have to be aware of. Okay, so all this stuff is affecting the oil market. So you look at the oil price now. So here you are. Now you are tasked with managing the exposure. You are the hedging team for Magma, and you look at your oil position and the underlying on the balance sheet. Okay, you have the underlying position. Now you are going through the decision problems, as the CEO told you to look at the decision problems. Now you've come to DP4. Should I buy or should I sell? I gave you the example where in running an active risk book, I was confused about what I should do in dollar yen, whether I should buy or sell. Now, in the case of the Magma Treasury hedging team, what is happening in the case of DP4 is, do they have to solve DP4 actively or what? Okay, the answers are already given. I'm asking you guys, but the answers are already given. Yes? Is my question clear? What happened? People are all sleeping. Raghav, let's ask.
Sir, can you repeat the question?
Okay, now let's ask Raghav. Let's see if Raghav is sleeping or not. Yes, Raghav, can you tell us, is my question clear? Raghav is also sleeping. That's why Raghav was also pushing me. I've started updating the attendance. Okay, I've started updating the attendance files. It's going to take a while. Okay. So yes, Vipul, now the question is, repeating the question, my point is that in the case of one of the real decision problems that we have to struggle with in the case of managing an investment fund is, when you look at any particular market, like say oil, you have to decide whether I want to be a buyer or a seller. What is my view on the oil market? Should I be a buyer or a seller? You have to decide, right? And then you analyze the market, you form a view, and depending on if you're bullish, you buy, if you're bearish, you sell. But now we're talking about different kind of problem. We're talking about managing a passive risk book. And we are having this discussion as to how do the solutions, what we are discussing now is, we are already familiar with these decision problems. What we are discussing is, when we come to the context of managing a passive risk book, and we look at the same decision problems, is there any change and is there any difference? As we saw, there is some change in the first two, because we don't have to actively think about these things. These are already on the balance sheet. The markets are already on the balance sheet, the KRF markets. We identify the KRFs, we know the KRF markets, and from the market, we know the asset class. If it's oil, it's commodities. If it's dollar yen, it's currencies. So these first two are automatically solved in the sense that we don't have to do anything actively to decide which market or asset class to operate in. Is this clear? But instrument, yes, we have a decision to make as to how we are going to hedge. What instrument are we going to use? Are we going to use to run the hedging program? Now, in this case, I have told you to use futures. So I'm like your corporate board. I'm like the corporate treasury risk management manual or the policy document, which tells you that you can't use options, you can't use spot plus FX swaps. You have to use futures only. So there will be, in real life, there will be, or there should be. I mean, I'm not optimistic that there necessarily will be, because we have seen how large corporations completely mess up their risk management. But there should be a kind of a policy document which outlines, which addresses this question. The question here is, what are the instruments that the hedging team is allowed to use as it goes about hedging the risks on the due to the risks that the company faces, which is basically the risk is that the net worth will go down. Net worth will go up, we don't consider that a risk. Okay, classical finance will consider that a risk, but we practical people don't consider it a risk. The risk is only asymmetrical, is that net worth will go down. So we are watching, we know the balance sheet, we know the underlying positions on the balance sheet. We are watching the KRF markets, we know the underlying positions, long or short, and we therefore are watching those markets very carefully. And if we see a chance that, if we see a risk that the markets will move in a way that will lead to the reduction of net worth, we will put on an opposing hedge position so that the net worth is protected on a net basis. Okay. So similarly, so what we are saying is now, this is basically the idea. Okay. So therefore, what I'm saying is, when we go to the question of the underlying, when we go back to the question of the decision problems, the buy-sell decision problem in a hedging context, do we need to actively solve it, or is it automatically solved? This is the question. Is it clearer now, Vipul?
Yes, sir.
Okay. Do you have an answer for this? Is it?
Not a specific answer. I don't think, sir, it's correct.
Sir, it is automatically solved.
Automatically.
Automatically solved.
Yeah. So you can see that is AA, right?
Yes, sir.
Yeah. So it's automatically solved. Why? Because if you see here, why is it automatically solved? Because remember what I told you, I just discussed with respect to the London whale disaster. And this, I think we have put it here in the earlier part of the, let's bring this now. We had, so this is the tutorial session which we had, where I had written some stuff. Okay. Now let's bring that here and bring it back to this. We'll just repeat the material, but that will be we'll know that, okay, in this case, okay, now, why is it automatically solved? Remember this now, think about this, that the objective, remember some of these things which I've given to you in your notes, okay, these are some of the basic notes, ideas about hedging, that the objective of hedging, so remember that example that is given in your textbook, where the treasurer is hedged and after that the hedge position is losing money, but the underlying position is making money. So the CEO is saying that we could have made more money if you did not hedge. That's actually a bad example. That should not have been in the textbook, because giving that example shows, and he's actually discussed it seriously as if this is a real concern. That's actually not, that example should not have been in the textbook, because it sort of reflects a failure to understand that the objective of hedging is to reduce or eliminate the total risk. It is not the objective of hedging to maximize your profits. Okay, let's write this again. I think it's written already somewhere in your notes, but I'm writing it again. And not objective is to hedging, when an entity has objective is to reduce or eliminate and not maximize profits. Okay, so that example talks as if the objective of hedging is to maximize profits, and it does not very strongly assert this principle. That's why I'm criticizing that example. That example should not have been in the book, okay, as an example which is as if something to be taken seriously. That is not to be taken seriously, because the objective of hedging, so if anybody tells you something like that, please tell them the objective of hedging is not to maximize profits. The objective is to reduce the risk and to bring certainty to cash flows. These points are written in your books, in your notes, not in the books, but in my notes. Okay, so please understand this very clearly. So therefore, this is what you have to understand all the time in any argument. Now, reduce or eliminate total risk. Remember when we defined hedgers, we said the first transaction will reduce the total risk. What is the total risk? Okay, we can write that also here as stepwise logic. Who is a hedger? Recapping, basically. Hedger, first you can go back and look at your notes. Where are your notes? Your notes are here. Where are they? Here. Types of players. Please look up your notes, okay, if you're confused. You'll find the definition here. But I'll just write it. Hedger, I'll just write it briefly. Proper definitions is given there. First transaction must reduce I'm not writing or eliminate, because elimination includes the idea of reduction. Okay, elimination is consistent with reduction. Reduction implies, if it is used along with the word eliminate, that means that reduction is not elimination. Some element remains, some risk remains, but we reduce it somewhat. Elimination means nothing remains. Okay, so elimination is also, it includes the idea of reduction. Okay, so I'm not repeating this. So reduction includes the idea of, is also basically, if you reduce it completely, then you will actually, so it is actually, I will reword that. Anyway, I'm not going to worry about this English language construction at this stage so much. You understand what I'm saying? First transaction must reduce total risk. Okay? Objective of hedging, always be very clear in discussions. As you can see, even a highly rated textbook like Hull has not understood this point, and he has given that example, which is a mistake actually. So many people don't understand this, and in fact, the people who manage India's oil risk also are not able to understand this, because we had a very interesting hedge transaction with Qatar with respect to oil gas purchases. But these guys basically did not understand this principle. And there was a situation like what is described in the textbook, where oil prices fell below the lower bound of the collar. So we were paying more than market prices. But these hedges are, today you're paying more than market prices. Okay, so basically something like this happened. All right. So this thing happened somewhere around here. You should also know this. Around here, basically, around here. So we had a collar where we were paying in this range, and then the prices fell below the lower bound. So India was paying this much for oil when oil prices were below like this. Okay, so India was paying, say, maybe 45, and prices were like 35 or something like that. So everybody is saying that, people started saying, why are we paying 45 when the market price is 35? But the point is, these buffoons don't understand that this is not going to remain there forever. You're paying 45 when the market price is 35, but also there's, in this structure, there's also a protection that you will not pay more than 60, even if the price goes to 80. So if you leave out this protection, if you give up this one, you will also give up this one. So when the prices, if it goes to 85, you will be paying 85, not 60. So these buffoons are so short-term oriented, they don't understand these things, and they think that the objective is to make money. The objective is not to make money, the objective is to reduce your risk. So unfortunately, these are the kind of people who are taking these kind of decisions for our country. And obviously the whole country suffers, okay? And this is not a matter of Congress or BJP. It's basically I think the bureaucrats who make the decisions, and whoever is basically the advisors. And it doesn't matter who is in charge, whether it's Congress or BJP, ultimately decision-making quality remains the same when it comes to these major economic decision-making aspects. Okay, so this is, now let's go back to this. These are all things you have to know about because it's your country and it's not being well managed on these fronts. We still don't have an oil hedging program. So our costs of purchasing oil go fluctuating every year up and down, depending on what's happening to the oil price. And then what happens is, then you don't have money left over for the other budgetary expenditures because oil you have to buy. There's no discretion. So you didn't have a hedging program. So suddenly last year you paid 64 billion. This year you're paying 140 billion for oil purchases. And so that money is not available for other spending. So, but anyway, should not worry so much about these things. It doesn't really solve any problem. Okay, but you should know these things. You should be aware of all these problems. Right, so coming back, hedgers' first transaction must reduce total risk. Objective of hedging is to reduce the total risk. That's why this guy's first transaction has to reduce total risk. Now, total risk is what? Underlying position plus hedge position. Risk on UP plus HP. Okay, so total risk on these two. Now, the question of hedging only arises when there's already an underlying position with some risk. Okay, so this is another thing that you have to understand. Whenever you hedge, because another thing we also noticed with a lot of people who have a very superficial understanding of finance, they start throwing around the word hedging without thinking. Hedging has a very specific meaning. The question of hedging can only arise when there is already an underlying position. Okay, I'm not even highlighting it. Underlying position means that there will be some positive risk. So only then you should use the word hedging. When you're doing something in a separate portfolio, you have one underlying position portfolio is on the balance sheet, you don't touch it, you are separately running an account, a brokerage account, which serves as a hedge account. And on that hedge account, you're opening separate offsetting positions. That is hedging. Okay, so in order to hedge, there must be an underlying position first. Okay, so what you do here is, this here basically is telling you the idea of the hedging. So let's go through this to understand, and then you will understand why it is automatic, why AA's answer is correct. That the DP4, buy sell, is automatically solved. You understand this logic here. I've tried to keep it stepwise. Okay, the question of hedging only arises when there is already an underlying position. Okay, and how do you do the hedging? How do you do hedging here? You execute hedge transactions. Hedge transaction will be either sale or purchase of a base asset or terms asset. And as a result of the sale or purchase, a hedge position will be created. If you do a sale, you'll have a short position. If you do a purchase, you'll have a long position. Okay. Now, if you're going to reduce the total risk, so you're doing a hedge position only because you're putting on a hedge position, that means there must already be an underlying position. Otherwise, it would not be a hedge. It would not be a hedge. So, but at the same time, you have to remember that the total risk has to go down. So the total risk can only go down if the hedge position that you put on has the opposite sign. This is what you remember if when in Hal Basu they were using the word offset. I mean, I have also used the word offset. This is very important. Offset. You understand what is offset? Yeah. Somebody's doing something, but I'm doing the opposite thing, so I'm offsetting whatever he's doing.
Yes, sir.
Right. So,
Yes.
this is how it works basically. Like, so you can see here that, so this is the point that you have to understand, that why must the hedge transaction be an offset. Now you see again here it is given in completely logical format. Once you understand, when you read through this and understand the logic, once you understand the logic, you will never forget it. Don't try to memorize anything. Spend some time to understand the logic. Total risk has to be reduced. First transaction has to reduce total risk. That's the definition of a hedger. Total risk is UP plus his HP risk. Risk on UP plus HP. Hedging is only when there is already an UP. Now you put on a hedge position. Okay, so after you hedge, you put on a hedge position. The result is a hedge position. Now, if the total risk has to go down, then the hedge position sign has to be opposite of the underlying position sign. If you remember that day, Utsav was making a comment about how does he know that these are long positions? Because the sign is plus on all these. The sign is plus. Okay. Actually, the sign is always plus even in liability side, but you have to understand really. But that was still a good observation. But you have to add that to the fact that, but if the sign is plus on the liability side, that doesn't mean that it's long. Okay, you have to understand this on the liability side, which means I owe. This is I own it, I have, and I have to pay liabilities. Okay, so if you have a positive figure, you're not going to have negative on the liability side. You'll still have positives. Okay, but because they're occurring on the liability side, there will be positions where you have short actually, because you have to pay. Everything on the liability side is you have to pay. You owe this stuff. So anyway, the point is that total risk, if it has to go down, the HP must have an opposite sign to the UP. That's why we make the statement. This is to understand the whole statement in HP in Hal Basu, where he's talking about offset, but they have not explained this whole scheme. Okay, that's why maybe it's not easy to understand. Once you understand this whole scheme, then you can understand the statement. That the goal of that's why the hedge position has to be an offsetting position. The sign of the HP must be opposite to the sign of the UP. That only then will the total risk go down, and you can connect it all the way to the objective of hedging. The very important point, because as you can see, even in well-known textbooks, they have failed to mention it, failed to understand it actually. Okay, and this is something you'll find out eventually. We will do, and you can see this actually. This is already given in the Hal Basu examples. See example in, if you see the Hal Basu examples, you will see essentially what happens. The net cost of purchase or sale of any asset liability is the price of the hedge position. Okay, so basically what will happen here is the current price is like this. If I now whatever the oil price is, okay, 52.92. If I that is of course lower than this 61, whatever, but anyway, it doesn't matter. I can still decide to hedge at 53 because I may feel that it is going to drop. So if I hedge it now at 53, that means essentially my net cost is my net realization, okay, for all this oil. Maybe I did not hedge. The oil was on the books at 61, 63, and I failed to understand the market. I did not hedge. But at 53 now I understand that the oil market is going to drop quite sharply. So I better quickly hedge everything. So I sell 25,000. So I sell 25 contracts because each contract is 1,000 barrels. So I sell 25 contracts quickly, and the result is let's say at 53. So the result is basically then I have essentially ensured that I will be realizing $53 for this 25K barrels. That's basically what it is. Okay, this is a statement that we are making here that you will understand once you understand the once you go back and read through the examples in Hal Basu, again you'll understand this. Okay, so the point is, as you can see, the point. Let's go back to what the point that AA was making. What is our question with respect to DP4? In the case of active risk books, the problem that you have about deciding whether I should buy or I should sell, that's why you decide whether you're a momentum player or a mean reversion player and this and that. All those problems don't arise in passive risk books because this buy-sell problem is automatically solved. Because where does it come from? Remember this rule. first transaction must reduce total risk. For a hedger, you're a hedging situation now. We are asking this question for a hedger. What is the buy-sell problem? Is it automatically solved, or do we have to actively solve it? The answer to that lies in this rule. You know that the definition of a hedger is the first transaction must reduce total risk. You can go back to your notes file and read that file that I've talked about. Types of players in financial markets. Read that note in that file, okay? The first transaction must reduce total risk, and therefore, in order to do that, the sign must be opposite to the underlying position sign, which means straight away that if the underlying position is long, your hedge transaction has to be a sale. So your hedge position has to be a short position, which means basically this: if your hedge position has to be a short position, then your hedge transaction, which is the buy-sell, relates to the transaction, not the position. Therefore, the hedge transaction has to be a sale. So if your underlying position is long in any market, you go market by market and look at each of the decisions. I mean, look at the buy-sell for each market, each KRF market. In each KRF market, you already have an underlying position. So for a hedger, this decision does not need to be actively solved. It is automatically solved. In the case of oil, for instance, you know that your underlying position is long. So your DP4 buy-sell is automatically solved. You know you have to sell. So there's nothing to decide here. Is this clear to everyone? You understand this?
Yes, sir.
Yeah, maybe think about it, go through this once again and understand it. But this is the point. So the problem really is going to be on DP5. Okay, so it really reduces to a problem of DP5, which is, remember that our DP4 and 5 were quite clearly connected, which is, even if we thought that we are going to sell, we may not automatically sell right away. We may decide to, let's say if we have, okay. So even if we have decided that's it, now the oil market is looking dicey. I mean, we know that we have to sell because our underlying position is long. But I can't go long anymore, okay? That's not allowed. We'll come to that golden rule of hedging. Now, but at the same time, I may feel that although I know I have to sell, but when I look at the oil market right now, given all the situations that are going on, reduction in US production coming up, there's a chance that this oil, I think that this will go up to $60, $65 before it comes down, okay? So I think that there is still a chance that it will go to $60, $65. Then why would I hedge now at 53? Because if I want to sell, I want to sell as good at as good a price as possible. Because remember, that is the price I'll be locking in. Remember this. Net cost of any surgery is the price of the hedge. Price of the hedge position, which is basically the price at which you do the hedge transaction. So why should I sell at 53 when I know that, well, I don't know actually, nobody ever knows, but I have a strong feeling, and you're supposed to use your views in taking your decisions. That's the whole point of a role in the financial world. I think it's going to 65. So I'm going to wait. So as far as DP5 is concerned, DP4 is automatically solved because I don't have an option to buy. I have to be a seller, okay? But DP5 is still there. DP5 I can solve actively because I can take a view. Because remember what is DP5? If you refresh your memory, enter right now using market order. Enter at a more favorable price using limit order. Enter at a less favorable price. Okay, there. Great. So we'll continue in the next class. But the point here is to understand that DP4 is automatically solved, but DP5 can be actively solved. I'll just give you a brief statement so that essentially you have a choice. It's all based on your view now. This is what you're going to be doing in your hedging in your project. You know what you have to do on DP4. That depends on the underlying position. You have to put on an opposite position, but you still have some discretion. You don't have to mechanically sell right now at the market. You can use a limit order to sell at 65. Or you can decide, and then eventually what might happen is you may end up, you may decide that I won't do it now, but I'll place a stop order to sell at 46, because if it goes below 46, then it will really drop. So we'll come to that discussion in the next class, but this is where we leave it. But the point to understand here is that DP5, this is where your discretion is. So your entire project is basically on DP5. You're going to use your discretion. You're going to take a view and decide whether you're going to wait and sell it at a better price, or you're going to immediately sell it right now because you think that it's going to collapse right now. Or you're going to set a stop, a trailing stop like this. That's your project basically. You track this and you put a stop maybe here. You feel at 45.80 there's a base here, and you're not going to do anything. You think this is going to 65, but you're placing a stop sell order here because you know your underlying position is long. You already have a position. So that's another way. This is using a stop order. So we put it back in the DP5 framework, and DP5 is to be actively solved. Okay, so your class is dismissed. I've taken just under 2 minutes extra. So if you have, the rest of you can leave. And if you have any conceptual question, you can ask me. Anybody has any conceptual question here? No? I still have to reset your accounts. I have that on my head. I have to reset your accounts. I'm doing your attendance. So, as far as the, okay, so as far as some tutorial sessions have to be set, let me just talk about when we are going to set them. We are, okay, so I'm going to stop the recording here.